Meet Ryan. Ryan discovered investing the same way most people discover conspiracy theories through short-form videos at 2 a.m. 3 months ago, he didn't know the difference between revenue and profit. Today, he refers to himself as a macro-focused growth investor because he watched 4 podcasts and lost sleep listening to finance bros explain the economy with LED lights in the background. Ryan's daily routine is simple. Wake up, check crypto, check futures, post bullish under random stock charts, repeat. His entire portfolio consists of AI stocks, leverage ETFs, and one company that claims it's revolutionizing cloud infrastructure despite having negative earnings and an office above a vape shop. But none of that matters because Ryan is up 48% in 6 months. And when someone makes 48% in 6 months, 2 things immediately happen. First, they stop listening to experts. Second, they begin giving financial advice to everyone around them. Suddenly, Ryan is telling his Uber driver why traditional valuation metrics are outdated. He's explaining to his friends why diversification is for cowards. He's even started using phrases like, "You just don't understand the future of the market." Now, here's the scary part. Ryan actually thinks he's good at investing. And honestly, the market has probably convinced him that he is. Because over the last decade, markets have rewarded one thing more than almost anything else: aggressive risk-taking. For years, investors were taught that successful investing meant patience, discipline, and buying quality businesses at fair prices. Then the internet showed up and replaced all of that with buy the dip, diamond hands, and people turning cartoon dog coins into Lamborghinis. At some point, investing stopped looking like finance and started looking like a multiplayer casino with motivational quotes. And during a bull market, casinos are incredibly fun. That's because rising markets hide bad decisions. A terrible investment can still make money when liquidity is everywhere and optimism is unlimited. In environments like that, confidence grows faster than skill. Ryan doesn't see luck. He sees talent. He thinks his gains came from intelligence, not from a market where almost everything was going up at the same time. And that illusion is dangerous because markets have a way of humbling people the second they confuse momentum with genius. Eventually, conditions change. Interest rates rise, growth slows, speculation disappears, and suddenly the same investors who looked unstoppable begin posting things like, "The market is manipulated." That's when reality hits. The stocks that used to jump 12% in a week now fall 40% in a month. The leveraged trades stop working, the buy every dip strategy becomes a speed run towards financial depression. And the investors who survived usually weren't the loudest people online. They were the boring ones. The people who understood risk, the people who accepted slower returns, the people who knew that protecting money is just as important as making it. But boring doesn't go viral. Nobody watches a YouTube video titled, "How I Consistently Earned 8% Annually Through Proper Diversification." People want excitement. They want overnight success. They want the fantasy that markets are easy. And in bull markets, that fantasy feels real, which is why inexperienced investors often outperform during euphoric periods, not because they're smarter, but because they're willing to take risks experienced investors avoid. Sometimes that works beautifully, until it doesn't, because eventually every bull market creates the same thing: a generation of investors who think risk and intelligence are the same thing. And when the cycle finally turns, the market delivers the lesson it always delivers. Making money during easy times is not the same as being a great investor.